I'm going to start recording on this computer. Very nice. We're going to stop that.
Okay. Let's see if I can get my video.
All right. Bronson, if you're there, speak up, please.
Hello, hello. I'm here. Can you hear me?
All right, good. We're off the the webinar jam.
Well, we are now officially live. So welcome everyone to the
Hold on just a sec. All right. Very good. All right. Awesome. Bronson, if you can just go ahead and make sure everyone's muted, and let me make sure I have you as a co-host, and then we can get going.
Okay, sounds good.
I don't see Bronson as a, where are you right now? I don't
He's
see
there.
him. Oh, he's there. You're a co-host. Okay, good. Just make sure that screen sharing is disabled if you can for any kind of participants. We're going to put everybody on mute, and we will have chat enabled for questions. And my rules are always the same. We have a chat enabled for you guys to, nice shirt, Scott Cunningham. I love it. And enable for everyone, but you got to be nice. Okay. You got to be nice to each other. You got to be nice to the panelists, and just, don't pitch anything. Like, that's just not cool. If we find you doing that, we're just going to quietly remove you, and that'll be the end of it. Other than that, remember, if you have any technical difficulties, it's never my fault. It's always someone else's fault. Just hit refresh, try to get into the call again. But we're gonna have a good time here today. We have a fantastic panel of experts here. We have the Nighthawk team that we have on this call, and what we're really gonna want to do is we're gonna see where we are right now from a market perspective. We want to say, hey, how has multifamily investing changed through COVID-19? What kind of management challenges are we maybe seeing with some of our assets? How are we overcoming them? But we're going to talk in general also about, hey, what opportunities are coming down the pike? How are the investment opportunities changing? Are we going to get more deals? Are we going to get fewer deals? Are returns going up, returns going down? How does this compare with the stock markets? Is there maybe better opportunities in the stock market? We're going to talk about investing in a recession in general, because we have some perspective on that as well. And we'll look at other economic factors. For example, the Fed printing money, effect on inflation, things of that nature, bankruptcies, unemployment, all that. How does that factor into your ability to make long-term financial planning? And so to help us through that is Bronson Hill, our Director of Investor Relations. Bronson, how's it going? And
hey, Michael, sorry, I had a little bit of technical.
Yeah, there are no more technical difficulties allowed, Bronson. So that is completely unacceptable at this point. Since we don't have a plan C, we just went to plan B. Bronson, are you there?
Yes, I am here. Are you able to hear me?
I am. All right. Well, just kick us off. Maybe introduce the panelists, the team on the call, and then fire away with some questions.
Okay, we are getting quite a bit of background. I'm not sure if you can mute everybody, Michael. Just mute every single person, and then unmute
I
me.
will.
I'm having trouble.
You just go ahead, and
okay.
I will.
There we go. Awesome.
All right.
For joining us today. We're really excited to be able to host all of you here. Thank you for sticking with us with the what we've had with the technical issues, but this is all about what's happening today in the market. We've gotten a lot of questions about what kind of deals are out there. How has COVID changed things? What should I be aware of as a passive investor? What does it look like from an asset management standpoint? These are all questions that have come up quite a bit with investors. I know that that's kind of why you're here, I imagine, is you want to know what's happening. So we're here to talk about that. We're here to give you a chance also to ask some questions at the end. So we're going to jump right into it. I just want to say one thing, and I'm really passionate about financial education, because really when times like this happen, most people have no idea what's going on. And this is where we educate ourselves. Robert Kiyosaki talks about financial education and financial literacy being just of the utmost importance. So today here, as Michael mentioned, we have the Nighthawk team. So I'm just going to go ahead and introduce those that have joined us. So you guys know Michael, but I'll just give you a brief introduction of him. So he's the founder and CEO of Nighthawk Equity and controls over $70 million in real estate across the U.S. He's helped his students purchase over 2,000 units valued at over $75 million. And he has his best-selling book, Financial Freedom with Real Estate Investing, and the Apartment Building Investing podcast. So I know many of you found us that way. We also have Drew Niffen, who's our president. So welcome, Drew. As the president of Nighthawk, he manages all aspects of our portfolio, the 1,700 units that we have at Nighthawk, including acquisitions, asset management, and capital raising. We also have Garrett Lynch, who's our director of acquisitions. He heads up our acquisitions teams and does all of the sourcing, underwriting, due diligence, and closing. One of the best deal finders and acquisition guys that I've met. He's been in multifamily since 2011, and at one point he co-founded a firm that grew from zero units to 3,400 units and a management company with 125 employees. So that's our team that's here. I am Bronson. I am the director of investor relations, and I am also a GP in over 700 units, and I'm really excited about what we're doing here at Nighthawk Equity. So just want to welcome the team. Format will go, I'm going to ask some of the team's specific questions, and then you guys can go ahead and answer. You can also change your view. If you're looking at this on Zoom, you can change it, hit the little button that says speaker view. So if you're in gallery view where everybody's there, you can actually hit the little button that says speaker view in the upper right hand corner. That will allow you to just see the person more up close that's talking. We will also give some room at the end for questions. So if you have a question, go ahead and jot it down. If it doesn't get answered, we will come back to that. We will have some time for questions at the end. So looking forward to this. So let's just jump right into this. So I know Michael gave his welcomes, but let's start with Drew Niffen. So Drew, why don't you tell us, just give us a little overview of kind of what has changed. We're in this post-COVID world. Like what has changed? Where are we at right now? We enter the twilight zone. What's happening?
Yeah, COVID was an amazing experience. And I don't want to talk about it only in the past tense because it continues to exist both from a medical issue, but also from the financial apartment building perspective. But it's been amazing for us. You know, we were doing everything as normal up in February, and then March hit, and all of a sudden everything started to pivot. So one big thing that changed a lot was our ability to acquire new properties and the circumstances that dictated those acquisitions. I'll let Garrett speak more on that a little bit later on. I'll speak more to what's happening to our existing in-place properties throughout the COVID process. And the real headline, this is the really surprising thing, is that not too much has changed. You know, the great thing, the very reason why so many of us have been pursuing multifamily apartment building in the first place is because it's not a luxury class. Everyone needs a roof over their head, and the government needs to support the idea of roofs over people's heads, right? So what that means is we haven't seen a huge spike in vacancy. We also haven't seen a huge spike in delinquency. So neither do we have vacant units, nor do we have too many units where we're not having tenants pay. And certainly when we acquire properties, one of the things we do is we stress test it. We say, how bad would the world have to get this property to not perform at all, right? And then depending on how narrow that gap is, we do or don't buy those properties. And situations like this are why we do that, right? So we have some properties, you know, where we got more into the weeds, more into the details with each one of our properties as COVID hit and as the full impact of it economically became more apparent to us. And one of the things we did is we said to every single one of our regionals, how many tenants at your property have had a financial hardship because of COVID? And so we monitored that number very carefully. It wasn't as bad as we thought it was going to be. Those tenants, we have worked with them either directly or through our property manager to look after them and try to take care of them in this sort of acute situation. But so far, our collections have been strong. Our occupancy has been strong throughout COVID, either because we're in B or C class properties, which are fairly recession resistant, and or the government has provided a lot of financial firepower to everyone in the extent of the checks that we've gotten that have helped our tenants make it through these tough times. So at a really high level, we haven't seen things be as bad as we thought they might be, simply because we are investing in a pretty recession resistant asset class, and because there's been the support of the federal government to help out people who have been displaced because of this.
Thanks, Drew. Garrett, do you have any thoughts as well? I mean, just kind of what are some things that have changed in general as far as the environment?
Yeah, so personally, what I'm seeing on the acquisition side is The first thing that happened is all the lenders kind of tightened the screws, and you saw a lot of bridge debt lenders fall off completely. Their programs are not open anymore. And then the only programs that kind of stayed in the game were either local banks or agency lenders, but they required new things. So they came in and required 9 to 12 months in principal and interest reserves, lower leverage, and the interest rate stayed down, which was nice, but they had different requirements on the net worth liquidity side that you're seeing, and just overall a lot of changes on that side of the fence. Now, to go back to what Drew said, as owner operators, we weren't seeing much of a change, and that is existing pretty much for most of the sellers that I ran into. They were just like, well, our numbers haven't changed. Why should we take a discounted price? Because nothing has changed on our end. And the reason that they need to take a discounted price is because it's changed on the buy side. The debt is not as attractive. In order for us to come and purchase a deal, we have to come with more equity to offset that lower leverage and the reserves that the banks are putting in place. And so the only way to offset that is by coming down in price. But sellers are not really motivated to do so. They're like, well, this happened so fast, let's just see if it can blow over. So what this whole process has created is a gap between buyers and sellers that a lot of times cannot be rectified. And this is one of the reasons why we haven't really been able to purchase anything in the first 6 months of the year, because of that gap that exists. Now, there's been some movement in prices, maybe 5% to 10%, but it's not enough to really move the needle to a place where transactions can happen. So the transaction volume has gone down by about 90% overall across the entire country. And that's been the biggest challenge to overcome, is just that gap that has been created. So that's kind of what I'm seeing in general on the acquisition side. We're still making offers. We're still being active and pursuing deals, but it's just been more challenging. And in addition, a lot of the deals that can be had are only deals that are occupied north of 90%, because that's what qualifies for agency debt. And without the agency debt, you can't go in and just use a bridge loan or any of that stuff. So there's a lot of deals that are 90% or higher, or maybe the ones that are, there's competition for those.
Yeah, so it sounds like what you're saying is that idea that, the sellers are looking back before COVID and seeing, hey, this is the way, this is worth, this many $10 million before, and nothing's changed. And yet buyers are seeing there's a little more risk there. And also we need to actually raise more capital for the same deal, which generally lowers returns. And so I know you're out there, you're a bulldog out there on the streets, hounding those for those deals, working hard than anybody, but it's still it's challenging. And that's why people want, why aren't we doing deals every week, every month? We're just really selective for the right deal. Can you maybe share, or maybe someone else can just talk about some of the criteria that we look for as far as deals, or maybe maybe how that's changed potentially?
Yeah. So the criteria quite honestly, it hasn't changed too much, except that we can't do as larger deals necessarily than we maybe could before, because we got to come with, maybe double the equity to the deals that we maybe could have done before. So if we could have done let's say a $30 million deal before, maybe we'll top out at 20 million or something along those lines, just because that same amount of equity closes a smaller deal than it did before. So I'd say that's the main criteria. We're also obviously not buying anything that has less than 90% occupancy at this time, because it's very finicky to try to go into a bridge program. The safest route is agency, and that requires you to raise all of the capital improvement money in addition to everything else. So if we're going in with $2 million in CapEx, we got to raise that in equity in addition. So that's adding to the amount of money that goes into a deal. So that's it. As far as changes go in that process, it's just maybe smaller deals, in areas that are more heavily insulated to withstand this kind of impact. We're not going into the C class areas quite as much. Trying to focus on location insulation as well.
Yeah,
In
I just
general,
piggyback on that. I feel like we've gotten a little bit more careful on two different areas. We are looking for higher quality assets in larger metropolitan areas. And I don't know how much of that is COVID induced versus a general trajectory, but I would think that in general, we've gotten more picky about where we're buying as far as like the metropolitan areas, and better apartments, newer vintages, those sorts of things.
the other thing also that's really impacted is how we underwrite deals. So, for example, now we're underwriting 6 to 12 month, escrows from the lenders are requiring. We didn't have to do that before. When we might have had 2 or 3% increase in rents, now we might be showing 0% for the next 2 years. So COVID, because of the uncertainty, has changed the underwriting, which means, of course, that we can now pay less. But the entire industry is affected by this. Therefore, we are seeing an adjustment in prices. We're seeing two things with sellers. Some sellers are just pulling back from the market entirely and going, I don't need to sell right now. I didn't have to sell. I was just getting crazy prices, so I'll sell. But now I'm not going to sell. And then there are other people who did need to sell, and those are going to be the more motivated sellers. So that what we're seeing is the more motivated sellers. We're seeing almost exclusive off-market activity right now, but it is affecting the underwriting in the way I just described, which means that we are forced, because of those two factors specifically, to basically offer less. And so that's kind of what we're seeing. On the other hand, at the same time, while that's going on, there's a downward pressure on prices because of the tighter underwriting requirements. There's much less supply on the market. But look, the demand for multifamily was still there 3 months ago. That hasn't changed. People are still looking for a risk-adjusted return on their money. They're looking for cash flow. They're looking for appreciation. They're looking for tax benefits. That has never gone away. Meanwhile, the supply has gone down by like 90%. So what's happening is that despite the fact there's downward pressure on the prices because of COVID, it's being held up because of this demand. There's still the same amount of money chasing now a fewer set of deals. So reconciling the two has been a little tricky because we can't go in with the same underwriting we had 3 months ago. And so that scenario makes it tricky. So the only way that we're getting any kind of activity right now is almost strictly in off-market deals. Gary, what would you add to that?
So I would also add that we have to put in financing contingencies as well into the offers, because
right.
Before pre-COVID, what was happening? No financing contingency, and hard money a lot of times is getting really heated at the top. And now we're seeing that we have to put a financing contingency in, typically no hard money. And so the terms have changed quite a bit, maybe 45 and 45. So 45 due diligence, 45 close. You got to think like in a due diligence process, it's taking longer because let's just say you need to get into every unit. Well, there's a COVID risk. So you got to plan around that as well. And that may take the lender a lot, or the third party reports longer to come out because it takes them longer to get through all the apartments. So it's slowing down the process. Our terms have changed as well in going into things. And so it's really interesting when you're trying to make competitive offers and try to one up the other guys that you're competing against, because it's like, how much risk do you want to take on in that transaction process, really? And so we're trying to obviously mitigate that risk as much as possible, but you're seeing those 90% plus occupied deals a lot right now. It's just a lot of competition in that arena, and other people going after the smaller deals, even with cash, to try to get into them. One major adjustment we've looked at is trying to expand our toolbox of lenders and go after maybe local banks where we feel confident withstanding some kind of a recourse situation for a few years. So that's something we would never do before, most likely. But if we feel confident enough, go into that.
I think the major variable right now is financing. I think that is the one thing that has changed fundamentally, really, really drastically. Collections are about the same. we all feel pretty good about that. Financing really went off the deep end, and it's because of this uncertainty. And so I think the competitive differentiator right now, and what Gary's alluding to, is getting the financing. If we can find financing sources that approximate what we had before, even if we have to personally guarantee the loan for the next, 12, 18 months, we're willing to do it, because that's going to allow us to get into deals that we would never otherwise get in there. And I think the financing is going to be different. So we collectively have been talking to lenders and trying to uncover lenders and consider lenders we would never have considered before because of that.
Think about it. In a deal, your full capital stack, you got the debt and the equity, but the debt is like 70 to 75% of the entire capital stack. And that's the hardest thing to get right now, or to land it perfectly. And that's what's messing everything up, is because that large portion of the capital stack, the whole reason that this whole process works and these deals are amazing, because we get to leverage them with banks. And that's what's going through the most turmoil right now. And so that's why we're seeing all this chaos, and trying to catch a moving target or hit a moving target is kind of how it feels from that perspective.
It seems like there's a lot of changes on the lending side. So on the acquisition side, obviously we are still looking, we're still taking those at bats to try to find a deal that makes sense. And so we will, obviously, if you have joined our Nighthawk Investment Club, you'll be notified as soon as we have a deal in the pipeline. So we hope at some point soon we will land something, but it is continually changing. So stay tuned for that. Let's shift gears for a minute. Let's talk about, we kind of touched on this a little bit. I know, Drew, you touched on this, but can you talk for a minute about asset management? Just kind of how are things performing? I know in some areas, there are rent strikes people are talking about, there's people that are not paying rent. Like, how is that in our particular areas? And then what do we see kind of in general right now in the market?
Yeah. There was a lot of headlines about rent strikes, and fortunately that's remained just headlines. We have not personally seen that. I don't know of other syndicators who have come across that. I was also worried about tenants who might, take advantage of the no eviction laws. There's a lot of states that we are in where right now we are not able to evict. And really that's our one tool that we have with tenants. The bargain is we provide you housing, you pay us money. And if you break your side of the deal and you don't pay us money, then we don't provide you with housing. But right now, a really unscrupulous, tenant could take advantage of that and just stay in there and not pay and stay in there for a number of months. And I thought we might see more of that. We have not. People have generally said, if I'm going to have housing, I'm going to pay for it. So that's been a really pleasant thing to see. Yeah, we have had some heightened delinquencies, I'd say, but not as bad as we thought it was going to be. As Garrett was saying, our acquisition process has been a lot slower than we wanted to because of all the turbulence in the financing. And I would say that in general, especially with the stock market taking this big hit in February and March, the risk-adjusted returns that investors are expecting are coming down slightly from where they used to be. I think we used to hear a lot of people saying, oh, I want distributions in month one and I want 19% returns. And, I want those things too, but we can only take what the market will yield. And I think as people see that their alternative is this stock market that can go down 35 or 40% in a matter of a month, people say, the illiquidity of multifamily is actually a benefit because it keeps me as a long-term investor, and my emotions don't get the better of me. I don't just sell, when the stock market crashed. And so that aspect of it is making multifamily more attractive and making people want to pursue deals and willing to do it at a slightly lower risk-adjusted return. So those are some changes that I'm seeing in the last few months on our properties.
Yeah, and this is a good point. And I think Michael commented on a deal. I don't know the specifics of that, but he said, hey, we're not getting distribution on this deal. And I don't know the specifics of that deal, but when COVID hit, the first thing we did is went into cash reservation mode because we didn't know what was going to happen. So cash reservation means basically exactly that. Hoard cash as much as possible, meaning that all non-essential CapEx expenses are immediately halted. Anything that's not essential, we would immediately halt any kind of distributions whatsoever. And so because we didn't know we never want to run out of cash. So when Michael, when you're saying, oh, we didn't get distributions the second and the third quarter, to me, based on what Drew was saying, that's okay, right? Because the operator, I guess I don't know the situation in this particular deal, Michael, that you're talking about, but in our case, we said, hey, no distributions for this quarter, maybe next, we'll see. We don't know where it's going to go, but right now we're hoarding cash, because the worst thing you can do in any business, especially in multifamily, really any, is run out of cash. So
Right.
so not expecting distributions, but check it out. I mean, just what Drew was saying, the stock market can go down 35, 40% in a matter of days or a month, and the principal is going, yes, will it come back? Yeah, it'll come back. It might take a while. But with multifamily, I almost view stock market like the waves, right? The waves in a choppy water, and it's wind is howling, and you're gasping for air. And then the multifamily market is the quiet waters, 20 feet beneath. And that's kind of the way I view it right now. So we appear to be relatively insulated from all this stuff. The short-term effects are not there. The compound, the average annual return that we're seeing is still intact. While the cash flow may not be there right now, we're still accruing the cash. We will eventually distribute if we find we don't need it. So we are really pleased with how this is performing right now in a really major crisis.
And if I can kind of just brag for a minute, I spent like an hour and a half with our asset manager looking at the cash position of each one of our properties and their cash production over the last 6 months. And there's a number of properties where next month we're going to do a double distribution to make up for not distributing cash in Q1. So we'll do double in Q2 and kind of make up for it. So there's a lot of properties where we hoarded cash to just kind of make it through the storm. And as things seem to be settling out, we're saying, okay, it wasn't as bad as we thought it might be. Let's go back to regular distributions.
And this is something too. Go ahead, Garrett. Why don't you go ahead?
So just because they're being held right now to kind of weather through a storm doesn't mean that you're not going to get the distributions necessarily. And again, we don't know who that operator is, but it's just it could be just a precaution in the event that something goes crazy or whatever. Still got to be able to pay the mortgage, and that's like priority number one over paying everyone out in that environment. And so it could be coming double, like Drew mentioned.
So I wanted to say something, I'm a big Warren Buffett fan, but he has this quote that he says, it's only when the tide goes out, you can see who's been swimming naked. And so kind of the idea, these times distinguish who are the strong operators and who are the weak operators. So a strong operator, good operator will say, hey, we need to really hoard cash because we don't know what's going to happen in the next few months. So it's really wise to be able to take these steps going forward. We're actually kind of getting toward doing Q&A here in just a couple minutes, but I wanted to maybe, I put this in the chat, but there's a report that Michael put together comparing the stock market and commercial multifamily real estate. And it's the michaelblanc.com/report. So you can take a look at that. It's a great, compelling report. Michael, you mentioned the stock market, basically being like waves. Is there anything else that, any other economic factors, any other information you'd like to share just in general, right now with what we're seeing, even, why multifamily is still a wonderful investment compared to other investing alternatives?
Yeah, I mean, the thing that's really relevant right now is inflation. I mean, there's a number of articles on CNN and Fox News and Wall Street Journal that is drawing attention, and the real estate guys have been saying this for a long time. Inflation, and it's because the Fed keeps printing money. This is how the Fed got themselves out of the last recession. They said, "Oh, I know, I'll just print a bunch of money and make all these problems go away," and it worked really well in the last recession. And so that's exactly what they're doing, but they're doing it at an order of magnitude that is stunning. Okay, they're just creating money, and there's so what happens when we just flood the market with money? Okay, now we're seeing this interestingly with some of our tenants. Some of our tenants who actually may have lost their jobs with COVID or others, they're actually making more money through the unemployment benefits than they are making their job. They're like, well, should I get a job again or make more money? So if there's more money all of a sudden being flooded in and people have more money, then obviously the price of things will start going up. Okay, so eventually, inflation is going to be a real problem based on all the money that we've been printing in 2008 since then and now through this. And we're not done printing money yet, by the way, because clearly it's not going away tomorrow. And the Fed is going to keep doing what it's doing to get us through this thing, and they're going to keep printing money. Eventually, inflation is going to rear its ugly head. Okay, and that's going to be a problem. That's going to be a problem. Stocks, you're not protected from inflation. Okay, so this is where you guys thinking about precious metals. And precious metals are a great hedge against inflation. They say that back 100 years ago, 150 years ago, an ounce of gold bought a really nice suit, right? Today, price of gold is around $1,700 will buy a really nice suit. So interestingly, the gold in absolute and in relative terms has maintained its value. The other good thing, if you read these articles, is that people, and even the big institutions, are recommending real estate as a hedge against inflation. Wow. Why is that? Because if let's say there's 10% inflation, which means that rent is going up 10%. What does that do to the value of the property? It's going to go up. Okay. So the value, the investment in multifamily syndications is a hedge against inflation. And that's really what I love about it. There's other benefits. Obviously, we talked about the tax benefits, the cash flow, and all that stuff. But the inflation thing, like, that's going to be a seriously major benefit and a major differentiator over the stock market. Plus, this giant thing of the uncertainty. Now, look, all you guys and gals on this call, the reason you're investing at all in the stock market is you're trying to make some kind of financial plan for the future. You're trying to secure your retirement, send your kids to college, and you can't do it. You don't know what the heck's going to happen next week, next month, next year, right? 2008 crushed a bunch of people's retirement. Same thing now, right? So if you're close to retirement, you got to pay for college, and your 529 just took a dive. You're like, this is insane. I can't plan for the future. And that is really frustrating to people. And so we think we have a solution to that. The only major downside is the illiquidity of these investments. You're tied up for 5 years. Okay, that kind of sucks. I get it. That kind of sucks. But there's an actual average compounded return that you get with syndications. You get the cash flow and the tax benefits where you can actually do some reliable planning. You can say, I put in $100,000. We're going to double our money in 5 years, and I'm probably not going to pay any taxes on it. That's pretty cool. I can actually start doing some planning on that, and you can't do that with stock market. Other than that, I don't feel very strongly about it, Bronson.
I can tell. I was hoping you get a little more excited, a little more animated there, Mike. All right, we're going to shift in a minute. Did you have anything else to add, Garrett or Drew, to what was shared there? I want to put you on the spot.
So there was a mention of the unemployment ending in July, and that is, so they have boosted unemployment right now until the end of July, and so I think what they're attempting to do is to boost things until the markets reopen up and people can go back to their jobs, and so there, that is something obviously to watch out for, and that's through this entire process in COVID land. It's always been like, people are like, oh, well, wait until May, wait until June. July is going to be the worst month, and so far it's maintained, the collections and all that stuff. So there's always like something around the corner, like watch out for this next. I'd say the next thing that people are looking out at is this unemployment situation ending, and so, but even so, I think we're in a position where we feel very strongly like things have been moving very well on our properties, and we haven't seen too much of a shift on the asset management side.
Awesome. We're going to go ahead and turn to questions now. We do have a few minutes for questions, so if you can go ahead and type them in the chat box, that would be great. We're going to start taking questions, and I just wanted to say one thought on that as well. With the easy money policy of the Fed, and just even kind of what you're saying, Garrett, as well as Michael, it's just that they're going to continue. What's most important is that people stay in their apartments. They have money for rent. So I believe that those policies are going to continue for a period of time, and it just is a great place to be, because that's like the first things, people need a place to live. So so we're going to start going through questions. So if you did your question earlier, I'm going to probably miss it.
I got some, Bronson. I got a few.
You got some.
Yeah,
okay,
I got some.
Great.
I think Paul Dengal was asking, and there's another one by Aaron about Class B and Class C, the effect of all the stuff, the Class B versus Class C, and maybe throw in some Class A there. Which one of you guys wants to take that question?
I'll take it. So there is no like defined rule for Class A, Class B, Class C. And I think it's one of those things where if you've been around long enough, you just kind of feel it out. But I give you some tips, right? So Class D is war zones. That's where there's shootings all the time and where you don't want to be at night and that sort of thing. It's just a really bad place, right? And we do not advise investing in Class D. It's just tough, really tough. Class C I call it workforce housing, right? Like I own individually some Class C. I think it can make a lot of sense. It's where a lot of people start out because it's inexpensive per unit. it's a lot of your tenants there work hourly wages, $16 an hour, that sort of stuff, $20 an hour. And the other way to look at these classes is based upon the year they were built, right? So 60s, 70s build is going to be at Class C. Class 80s and 90 build is probably Class B. And then maybe this century is going to be more like Class A, right? So you can kind of think of it that way. Class A is your nicest stuff. It's a lot of luxury housing. People that are in Class A are people that could have their own home, could have a single family home. They might have, a good $70,000 W-2 job and up, but they choose for various lifestyle reasons to live in an apartment or to live in a place that has amenities and they don't have maintenance ongoing for it. So that's your spectrum from just really nice Class A stuff where professionals live, down to Class B, which is sort of in the middle, and then Class C, where it's workforce housing, on down to Class C, which is kind of like a no-go zone.
So here the question really was around the effect of COVID on each of these classes, right? And
okay.
so,
Yeah.
Here's my idea is I think it looks like to me like the effect was less on, I think, white collar workers, because white collar workers who were going to an office could go and do their job at home. They just worked from their home office. Yes, a little disruptive, but I think it really affected more of the blue collar workers, right? Retail and entertainment and restaurants. And so those are some of the people that do rent from us. And so depending on the area, depending on where they are, like for example, Memphis, where there's a lot of logistics, a lot of, a little bit less than maybe some other places like Orlando, for example. But even so, the government stimulus packages hit those people square. Like, even though they're affected the most, they also got the biggest benefit of the government subsidies. We talked about the unemployment benefits, where someone making less than $40,000 a year would actually start making more money with the extra unemployment benefits than they were employed. So in some sense, the economic stimulus package really benefited the kind of tenants that are living in the Class B and Class C apartments. And this could explain why our collections are so constant.
Yeah, and I would say that if I had to make a guess as to what is going to get hit after all this dies down, it's going to be if you have a property that's not as desirable in an area that's not as desirable. So if you have a property and you're in, let's say, a B or C class area, you want it to be, one of the better ones on the block so that people flock to your place to go live versus, one of the dumps on the block. Those will probably get affected more, I would say, once this whole stimulus lightens up a bit. So we've kind of prided ourselves in having investments that are more insulated in better areas of the city. And, that's always, we want to have one of the better properties on the block. And so I think that's something to look out for as we move into kind of this next section of COVID post all the unemployment once it ends at the end of July.
Okay, so we're gonna kind of move a little rapid fire here because we got a bunch more questions and they're kind of coming in pretty consistently. So we'll try to keep the answers a little short because we got a few minutes. So Michael and team, do you see underwriting changing to a longer hold than the typical 5 years? If the answer is yes, have you considered using HUD financing instead of the typical Fannie Freddie? From David Camara.
No HUD. The HUD is something that you want to buy with a bridge loan and then flip into HUD because it takes like 6 months to get into one of those loans. I would not recommend going directly into a HUD loan right at this moment.
Yeah, you really can't.
You really can't. Yeah. So it's more beneficial just to go in, stick to agency loans or local banks.
If you're not sure what HUD loans are, you can look that up online. And they will give you some more information if somebody's curious about that. A question from Keone in Maui. Are you seeing Class A under construction that has come to a stop, or that might be a debt purchase opportunity in A locations? So are we seeing any sort of new construction distress type of situations now? Has anybody heard about anything like that?
I have not, but if you know about it, let us know.
Yeah, the ones that are fine are the ones that are already funded. So a lot of the people I know that are developing right now, they're already funded, and so they're just continuing with the process. But I'm sure there are some that have been affected that maybe are trying to do it in phases. There might be opportunity in that.
Okay, thank you. We have a question from Rafa. It says, how hard is it to get a loan for a property once you have raised the down payments? I think, Rafa, it might be a little helpful to know your situation, if this is a syndicated deal, if this is something that's obviously you raise the money, you may have any insight on that. I mean, it's more just you raise the money and you do the deal, but I don't know if there's enough information.
I mean,
there
it's much harder now than it was before. That's kind of what the theme of this conversation is, that the big way in which COVID has impacted our investing world is debt. And that's causing deals not to transact. So don't assume that's going to happen, and protect yourself with a financing contingency.
I will say this too, interesting from the investment side. I'm getting, 3 to 5 emails a day of like, hey, do you guys have a new deal? Do you have a new deal? There's a lot of people looking for deals, right? If you're an investor looking for a deal and you see a deal, there aren't nearly as many deals as there were 6 months ago, like we said. So there's going to be more investors fighting for deals, which could potentially lower returns, but it also means that you're in a deal versus being stuck in the stock market or in cash.
If you're hunting for deals, it's all, at this point, it's your relationships that are going to propel you forward. Every deal that I've gotten so far, and I'm getting quite a few, are all off market. There's very few that are actually on market that are worth pursuing or that exist. Those are just kind of tightened up. So you're not seeing the email blast coming out quite as much. So if you're trying to hunt deals down and get into one, you got to call people and you got to get a hold of them, and you got to, have some poise with them in order to try to get into something right now.
So we got a question here from Mary Chris, just asking, what are the actual returns investors accept? We typically have kind of been in the 14 to 16% IRR range. I'd say now we're, if we can get at least 13 to 15 range, we're comfortable. Would you say that'd be accurate, Garrett?
Yeah, I would say so. I think, we have to lower our expectations. It's better than the stock market, that's for sure, what we're giving out, but it's definitely, if we do have an offering that comes out, it likely, I would say, would be filled fairly quickly, doing better than stock market, even though it's going to be on the lower end. Maybe, pre-COVID, we would have had it closer to 15, but, 13% IRR is not bad at all.
Okay, great. So there's a question from Patrick to Garrett. Just what are some underwriting assumptions that you're using now compared to initially when COVID hit? So how have you adjusted your assumptions? I know that lending has been one, maybe just anything else within the...
I'll just go real quick.
Yeah,
Michael touched on this a decent amount, but the first thing is you got to take out any natural appreciation that you would have in the marketplace. People put like 3% at the top year over year. I put that at 0 right away. And then I'm trailing it in to the rest. So if the market's really strong, the second year, maybe I'll do 2% and then maybe 3% after that. But that's the first thing. The other thing is you have to put in those reserves, 9 to 12 months, depending on what kind of debt product you're using. Those reserves are going to be there. And then you can insert them back in your model in like year 2 or 3, so that you're not just sitting on the cash for the entire length of the hold. So I think those are like the major things right now. And then obviously lower leverage is a major change to the model as well, to kind of offset everything.
So I think we'll go to Michael on this one. This is from Will Dodd. It says, word is we are already in a depression and it is going to get worse. Deflation first, then massive inflation because of monetary policy. How will this affect multifamilies?
Well, I think I was talking about that a little bit earlier, right? I had a long rant about how gold and real estate, multifamily is a hedge against inflation. And so, yeah, we may get a little bit of deflation. I get that, but I think eventually we're going to get to, we are going to get to inflation and a devaluation of the U.S. dollar. It's a logical consequence of that. So I don't want to go over that again. I think really what I want to say is, I think collectively we are pleasantly surprised at how this is behaving. I think our biggest fear was that tenants would stop to pay rents because they couldn't get evicted. Then our second concern was that they couldn't pay the rent because they didn't have the money. And neither of those things happen. Now the question is, how much longer can this go on? I think someone asked, hey, what happens if the stimulus packages stop? Well, I don't know. I don't think the stimulus packages are going to stop. I really don't. I mean, why would the government print all this money, get everybody out of this thing, and then let everybody like crash and burn? It doesn't make any sense. So what they're going to do, they're going to keep on doing it. And they're going to get us through this thing. In the process, they're going to devalue everything. Inflation is going to start kicking in. The U.S. dollar is going to take a hike. And the combination of that and in a flat economic or maybe downward economic environment is going to exactly. And so that's what's going to happen. And real estate we're very well positioned to take advantage of that hedge. I think in the short to medium term, I think we are collectively overreacting to a lot of different things. Now, should this mean we should be insensitive to what's going on right now? No, I don't think we should be insensitive. But I think many people in this country are overreacting. And you can see that by the unrest and the protests. Sometimes people don't even know what the heck they're protesting about. They're just throwing freaking bottles into a window. I don't know. Maybe it can't because they can't go to a football game anymore. I don't know what it is. Okay, but people are overreacting. And I think really what I'm thinking right now is we got to stay calm. And we have to kind of keep the course, meaning that think back when you guys did your New Year's resolutions in late December, early January. Okay, you had certain goals in mind, certain things you wanted to do, and think back to those things. Now, some of those things you can't do anymore. Like we had goals for traveling extensively. Like that's what we wanted to do this year. Well, I can't do that. I had to cancel it. Damn it, really irritated me. Okay, but there are other things that were on your goal, like I want to invest a certain amount of money so that I can quit my job in 2 years, 3 years, whatever the thing was. And now we're asking ourselves, or I want to get started with multifamily, or I want to buy my first deal, or my third deal. And now we're like, oh, I'm not so sure. It's not the right time. But is it really ever the right time? It really never is, because 3 months ago, before COVID, it wasn't the right time. Why? Because it was hot. Okay, oh my gosh, maybe I shouldn't get involved in this deal because it was too hot. Okay, well now it's bad. Well, we'll say, when was the right time? Somewhere between now and 3 months ago. Did it last 2 hours? Was it a day? Was it 48 hours? Was there actually a really good time between 3 months and now? No, it never is. The point is, it's never really the perfect time to do anything, okay? Meaning that the lesson is the right time to do anything meaningful in life is right now, regardless of what's happening. Now, do you have to adjust your strategy? Yes, you do. And we talked about that. Your underwriting, you can't go in the same underwriting to 3 months ago. You have to adjust your underwriting. You might have to adjust your strategy, but it does not mean that you should stop doing what you're doing. And I think that's what we have done collectively in this country, is we just stopped doing anything at all. And we're slowly starting to come out of our shell, but I think it's taking too long. Does that mean that you should go to a bunch of social gatherings, hang out with your 500 closest friends? That's not what I'm saying. I'm saying you should continue your life. And especially those goals that are important to you, you should revisit those and continue making progress.
I think that's good. Stay the course. I like that. Was a good, as we'd say, we used to say that'll preach. So well done. So a question comes up about, we got a few more questions we'll take here, and then we'll kind of wrap it up, and we'll talk about next steps. And we are going to be doing more of these webinars as well in the future. So let's look at Class A. Somebody is asking here, Will is asking, does Class A seem to be more attractive in the future due to increased percentage of work from home employees or higher salaried employees? Is Class A going to become more attractive? Garrett or Drew, who wants to handle that?
I don't really think so. I mean, here's the thing. Class A is a good place to park cash. It's you have an indirect proportion. So like, think about this. Class A is your lowest cash flow and highest ability to equity grab, right? So, and then Class B, you got more cash flow and a good chunk of equity to make. Class C is heavier cash flow, less equity. And then D class is all cash flow and no equity. And that's how things are stacked. And so I think A class deals, unless it's a new development play, it's not going to be the best spot to jump into regardless. That's just my take on it. I think Class B and C plus are really where it's going to be.
All right, we're just going to take a couple more questions here. This one may actually, I'd love to know Garrett's thoughts on this, but where do you think rates are headed? Are we going to stay at a low interest rate environment? Do you think that they're going to go up? What do you think timeline of all this is going to happen?
We got like record lows right now, and it's gonna stay down for the time being. Now, the debt products that are bridge are going to be higher, a little bit higher than they were before. But if you're getting into agency right now, man, you're in the low threes, which if you can land a deal with this kind of debt, it's unbelievable debt right now, as far as just the rates go, not the leverage, and not the reserves. That all is kind of wild, but man, these 3% rates are unbelievable. And I think it'll stay down for a bit.
Yeah, we had a long-term, I think 12-year loan we got at a 3.48% rate last August, which was amazing on a deal. So thoughts on other passive investments such as self-storage, mobile homes, transitioning in and out of COVID? Any thoughts on other sorts of passive investments?
Yeah, I mean, I can take this one here. I mean, I think the biggest lesson for everyone on this call is you got to be open to alternative investments. Okay, you got to think outside the freaking Wall Street box. That is the number one takeaway from this call right now. Now the question is then, okay, once you're in that outside the box, you know, what else is there? And I can't answer that for you. All I can tell you is that you should look into a variety of alternative investments. And every single alternative investment has a particular purpose. For example, gold doesn't produce cash. Okay, so it's a really poor way to quit your job. Bronson, you still there?
I'm here, yes. Can you hear me?
Yeah, so gold is a poor cash flow generator, so you can't use it to quit your job, but it's a fantastic hedge against inflation and the devaluation of the dollar. Okay, but then there's oil. Oil is super tax advantage. It's the second in place after real estate. It's a great way to get tax benefits. You can write off the entire investment. And so you should look into oil. I don't have any oil investments. I'm a student of it. I haven't done anything. I am buying gold. And then there's real estate. And in real estate, there are different asset classes. Now, you probably don't want to be in office because everyone's working from home and it's going to stay that way for a while. Retail, not so sure. But look, mobile home parks have been around for a long time because it's the absolute most affordable housing you can buy. I like mobile homes. It's just not my style. Okay, I just don't love the idea of owning a mobile home park. It's also difficult to manage. Self-storage, I do like that. It's also recession-proof. And we looked into it a little bit. Also not my style. Really love multifamily. I just love the residential aspect of it. And there's multifamily. There is assisted living. Okay, assisted living is a up and coming thing. What I don't like about it is really two businesses in one. It's a real estate play and it's also a business. As in, this is kind of a medical play, right? So you have to have someone who has a heart for helping aging people. It's a medical thing. It's a people thing. It's a nursing thing. So you have to have an operator. You have to partner with an operator who understands and loves that kind of business. Coupling it with real estate, I love that. I love that play. It's very similar to here, and it's only going to get better in that respect over the next 15, 20 years. So there are different asset classes. Again, out of all of them, I do love multifamily the best. And what we're seeing right now is just a proof of that. I love the way it behaves in recessions. I love the cash flow and I love the upside potential. If there is a market recovery, which we'll have, it's going to be amazing. We saw that over the last 5 years. I mean, I had one of our students, Bruce Frazier, who bought a deal it was a 110 unit deal. And within that 1 year, he sold it. He was going to hold on for 10 years and he sold it because some knucklehead offered him so much money that he had to sell it. And so I love the upside potential of that. So, but again, the bottom line is there are different asset classes. Just look into them. Look into all of them. And every time you do a particular investment, it's either it has a particular purpose in mind and possibly diversification within an asset class.
To piggyback off that real quick, so I'm friends with somebody that's been doing this longer than me, and his name's Ken McElroy, if you guys know who he is. And I asked him, I'm like, so you've done pretty much everything, like every kind of asset class you've invested in. And is there a play that I'm missing right now? Like, should I be looking at something else? And the thing that shocked me that he said is he's like, absolutely not. He's like, of all of the things I've tried, hotels, mobile home parks, every different type of investment in real estate, in commercial, all that stuff, multifamily has been his go-to, and it's performed the best. It's been the most consistent. And so that was really reinforcing to just hear that. And I would say with any asset that you guys are looking to invest in, go with operators that have gone deep in that industry. They know the insides of the business, or they've hired a lot of people. They've hired people that know the business inside and out. And the people that are just getting started, be a little bit more weary with them. But the people that have gone deep and know how to pivot properly, those are the people you want to stick with in any asset class and in any investment.
Awesome. Guys, I think we're going to go ahead. It looks like, Michael, you're like in a cave or something. It's so dark there. So they really watch the sun go down on you. There you are. Awesome. Well, this has been an awesome time. I think we're going to go ahead and wrap just to be for the sake of time. And we're going to start to do this quarterly. So if you have some topic that you're like, hey, I really think we should talk about this. I think this is really great. I think we talked a lot about, the asset management, what's happening, the support we see behind that, the challenge in lending, kind of reducing deals, but yet there still are deals out there to be had. So people are still closing deals. But I wanted to also give you an opportunity. I know some of you are a part of the Nighthawk Investment Club, which are deals that we're doing. If you are not, you can go ahead and join. I'm putting a link into the chat there that shows how you can join. So if you go to that link and you just click join, you can set up a call. We'll get you on our Nighthawk Investment Club list. The next quarterly webinar we're looking at toward late September, tentatively September 23rd. We have not confirmed that date, but that's likely when we around the time we will do the next webinar. So if you have thoughts or comments that you would like us to go over, I'd love to know what those are. I'm going to put my email in here too. So it's bronson@nighthawkequity.com, or if you have any questions, feel free to reach out to me. But it's really a pleasure to be with all of you. Obviously, to Michael and Garrett and Drew, it's been great being a part of this as well. Any last comments, Michael? I know you're the passionate one that likes to send us off.
Yeah, I want to thank everybody for being on your call here in your evening, late afternoon. And I just want to encourage you guys to check us out at Dealmaker Live, dealmakerliveevent.com. This is a great way. We're really going to condense every aspect of investing, either actively or passively in multifamily, in like 2.5 days. So we're going to talk about the active side, finding deals, raising money, marketing, but we're also going to talk about the passive side. So whatever you're interested in, we're going to condense it in 2.5 days. And it's super affordable because we're bringing Dealmaker Live to you guys, to your laptop, your phone. Even though we would prefer to be together in person. That's coming up middle of July, July 15 to 18. It's a great way to connect with us and also with others via the networking and learning as well. So make sure you check that out, dealmakerliveevent.com. And yeah, so thanks, Bronson. I really appreciate you putting this thing together and moderating it and the great questions.
Yeah, we're gonna do more of this, and so again, from each of you that are watching, we just want to know what it is that you would like to hear and see and hear us talk about, and all of that. I'd love to get some feedback on that. So feel free to reach out to me, and just again, thank you for taking the time, each one of you, to educate yourself, because that's really the thing that separates you and the thing that's going to change you year over year, month over month. It's just basically your education and what you do, and being able to educate yourself, especially during this time. So. Thanks, everybody. Hope everybody has a wonderful night, and we'll see you on the next webinar.